Now basically the answer is over. I just want to give you some explanation which is a very raw or very basic calculation. Suppose my friend had approached me with a question that whether I should invest in the project or not. I made the NPV and I said, yes, you should. Now he tells me that, say, Maulin, you just tell me that, say, whether I should accept the project or not, because I have a fear that, say, I should not end up with the wrong decision. Then I showed the calculation of NPV to him and I told him that, say, see, NPV is positive, you should accept this project. He tells me that, say, Maulin, I don't understand all this, what you have done. Can you just give some simple explanation? Because I am going to borrow funds for the purpose of doing business. I am going to borrow funds for the purpose of doing business. Then I told him something like this. First year beginning, you borrow an amount of 10,000 for the purpose of making investment in the proposal. 10,000 into 25%. In the first year, the amount of interest that will be debited to you by bank will be 2,500. So end of year 1, your repayment liability is 12,500. As per your information, this is the amount that you are going to receive at the end of the first year. You do one thing, you make repayment of the loan out of business cash accrual. So second year beginning, outstanding principal will be 8,500. Now 8,500 into 25%. The second year interest will be 2,125 plus 8,500. So this is the amount that you have to pay to repay the loan at the end of the second year. Again, you do one thing. Whatever the amount that you have received from the business, based on your information, you use it for the purpose of repayment of loan. That is 7,000 rupees. So now, third year beginning, the principal outstanding is 3,625. So 3,625 into 25%. Third year interest is 906.25. So now you have to pay 4,531.25. Okay. Based on your information, the expected cash flow is 18,000. Out of this 18,000, you do one thing. You make repayment of loan rupees 4,531.25. So the remaining amount is a kind of benefit that you have. What is the remaining amount? That is the surplus amount, 13,468.75. What does it mean? It means that after repayment of the entire loan, including interest, the entire loan is repaid, including interest, and you have a surplus of 13,468.75. Are you happy with this? He said that, Maulin, I'm really happy with this cross verification that you have shown me. However, yet only one small query. Earlier you had shown me something like 6,896. Now you are showing me 13,468. So why these two values are not matching? I told him that, say, both of them are same. He says that both of them are different. I explained him that 13,468.75 is of year 3 cash flow. So into PVIF at 25% for third year. So 13,468.75 into 25% third year factor is 0.5120. That comes to 6896. So NPV is indicating that the entire loan is repaid along with the interest, and then you have a surplus equal to the positive NPV. That is what I explained it to him. He went to his home. Next day, his father is making a call to me that my son is foolish. He does not know that we are not going to borrow funds. 25% is our opportunity cost of capital. This is the rate at which we can invest the fund somewhere else. And I don't feel that this project is worth undertaking, that it is going to compensate 25% opportunity cost. So I think that there is some error in your calculation. So I explained uncle something like this. So now I am giving explanation to my friend's father that investing in this project is better than investing somewhere else. How? Let us see. I can tell to him that see, the option number 1 is that you invest 10,000 rupees somewhere else at the rate of 25% for 3 years, because you have a contention that 25% is my opportunity cost. So 10,000 into 1 plus I raised to n, 10,000 into 1.25 raised to 3, 10,000 into 1.95 3125. So it is 19,531.25. This is year 3 end. So this is the amount that you could have received at the end of the third year. Now instead of investing somewhere else, you invest in this project. As per your information, I have calculated the cash flow. First year it is 4,000, second year it is 7,000, third year it is 18,000. You have told me that my opportunity cost is 25%. So let us reinvest this 4,000 at the rate of 25% for 2 years with the reinvestment rate information that you have given to me. So square of 1.25 into 4,000, so it is 6250. 7,000 into 1.25. Because second year end the amount that you receive is reinvested for 1 more year. Because basically we are required to make both the options comparable. And this is the third year amount. Okay. So 6250 plus 8750 plus 18,000. So we can receive from the project an amount of 33,000. We understand that what you could have received otherwise. We understand that you could have received otherwise an amount of 19,531.25. And if at all you make investment in this project, then what do you receive? You receive 33,000. So do you receive more or less? More. How much more? You receive more by 13,468.75. Again we understand, of course, the discounted value, present value of the same is equal to the NPV of the project, that is 6896. This is what we understand. So we can say that if at all we accept the project which has positive NPV, it will recover the opportunity cost of investing the funds somewhere else. Whatever the rate at which you could have received return somewhere else, that is entirely recovered over here, and something more you are going to receive over here. What you could have received otherwise, 19,531.25. What you receive over here, 33,000. You receive more or less, you receive more. How much more? Equal to the positive NPV in discounted value term in the present value term. Now friends, when I go to buy a calculator, then what is the first thing that I do? The very first thing that I do when I go to buy a calculator is that I will do 10 plus 10 is equal to. I know that the answer is 20 and I would like to verify that whether it is functioning properly or not. I will not do 66 square. Why? Because I don't know answer. How will I verify the answer? I will verify something which is simple. So here we have verified that whether NPV technique is working properly or not. This is a verification process that I have explained to you with respect to NPV analysis. So let us note first point. Based on above working, we can say that if NPV is positive, comma, it means entire loan is repaid along with interest, comma, if the company has borrowed funds. Second, if cost of capital is opportunity cost comma, then positive NPV means entire opportunity cost is recovered and equal to positive NPV surplus is left. Full stop. Third point, importantly, an assumption is made that all cash flows will be received slash paid at the end of year. Now dear students, over here one of the important assumption which has been made is that all cash flows are arising at the end of the year. May it be the revenue, may it be the expenses or income tax liability, everything is at the end of the year. So all cash flows, inflow, outflow, is say assumed to be received or paid at the end of the year. This is a unique assumption which has been made in financial management throughout. Means the entire sales revenue is generated at the end of the year. All expenses are paid at the end of the year. Income tax liability at the end of the year. Everything is at the end of the year. That is the kind of assumption which has been made. Now over here, one important point is that the financial management for majority of the techniques, not for all, for majority of the techniques, they depend upon, that is it depends upon the cash flows rather than profit. Financial management is of the opinion that the profit is easily manipulated. You change your accounting assumption, your profit will change. You change your accounting method, your profit will change. So the profit can be easily manipulated, but the cash flow is not. That is the reason say we should take the decision based on the cash flows rather than profit. That is what say this, like the decision making criteria has an argument. Next point. In most of the techniques, in financial management, comma, cash flows are taken into account. Cash flows are taken into account instead of profit for decision making. Full stop. It is argued that profit is easily manipulative. Profit is easily manipulative with change in accounting assumption slash method, comma, profit can be changed, not cash flows.